something happening here. What it is ain't exactly clear. There's a man with a gun over there, telling me I got to beware. I think it's time we stop, children. What's that sound? Everybody look what's going down.
All right, welcome, GK shareholders, clients, fans, friends, and family. I am back for another live stream for the first quarter of 2025. This is for GK clients to discuss the different individual stock positions and our macro view of the economy for your entertainment and knowledge of why and where we're investing at this time. And I'm going to begin with a macro discussion of the policies of the new Trump administration and how it's affecting markets. We're in a market correction now. Why? And what to expect moving forward with the new administration and the changes in policies and approach to our economy and our taxation system that are happening under the Trump administration, and what its potential effects will be for you, our clients, over the next year. Obviously, we cannot predict the future, and the predicting of the future business is a bad business to be in because you're always wrong trying to predict the future. And especially today, where I think the volatility of the administration makes it even harder to try to parse out what are the consequences of different actions and how that will affect your money and markets. So, as I say to my clients constantly, it doesn't really matter who's president. What matters is that we try to make money no matter who's president. And what we try to really do is understand the environments that we're in as investors to take advantage of the opportunities that are presented, but also how much risk is appropriate for our investors at different periods of time. So let's start with the macro. The question that everybody is asking me commonly today, and most of the interviews that I'm getting, are about tariffs. And obviously, tariffs are a complicated system that we're not going to get into in detail today, but is being upended by the Trump administration, demanding large tariffs on many of our trading partners and allies, including Canada, Mexico, and Europe. Of course, China as well, which also sells Americans a tremendous amount of goods. But before I get into why tariffs are harmful to America, I want to go backwards a few minutes and talk about why do we have a global economy in the first place? And where did it come from? And it started many, many, many years ago. Mostly probably when I started in the industry in the 90s, we saw the rise of the personal computer and eventually the internet, which made globalization much more effective for companies. And companies like Dell were some of the first companies to innovate just-in-time inventory, for example, and globalization like manufacturing in multiple places in the world with just-in-time inventory. And they created efficiencies and profitability in businesses that had never been seen, which created the first dot-com boom, which ultimately led to a bust because the valuations got so extreme. But it didn't change the fact that there was a tremendous amount of innovation around the internet and globalization and how they worked together in creating efficiencies and profits for U.S. companies. And this led to one of the most profitable times in the markets in the United States history during the 90s. So from 1995 to 2000, the markets had an incredible run with 5 years in a row of 20% gains in the stock market. So you can only imagine we've had 2 good years in a row. Imagine 3 more years just like the last 2. Well, you're going to have to imagine because the chances of that happening are pretty low with the current administration. So why globalization? Well, over the last 20 years, China has risen as a major economic force, but also a major consumer of American goods and foreign goods, as well as China became a massive economy over the last 20 years. China being probably, and the emerging markets, one of the greatest areas of growth. So let's say you're a company like Coca-Cola, and throughout World War II, you expanded all throughout the world as U.S. troops brought Coca-Cola everywhere in the world, and everybody in America drank Coke already. So if you're Coca-Cola and you want to expand your business and you know consumers around the world have heard of your brand, then you go to those countries and you try to sell in those countries. And each country has its own set of rules and taxes and laws for companies to sell in. Countries that have friendly rules and governments tend to have lots of consumer goods and choices for their citizens, and lower prices and much better choice. Countries that are protectionist, it's basically the concept that if we protect our industries and our jobs, that somehow this will create a better economy for those countries. So protectionist countries put tariffs on foreign goods to try to keep the domestic goods competitive so that the domestic economy will stay good and jobs aren't outsourced to other areas. So protectionism creates lower quality of products, less choice, and in many cases, in a more inflationary environment because there's no way for companies to lower their costs of goods by going to other countries, for example. So tariffs are protectionist in that if we create a higher price for the foreign goods, it will make domestic goods more competitive. Now, this would be the argument why tariffs aren't 100% bad, because if it creates jobs in the United States and if it creates higher wages and a stronger economy in the United States, then maybe tariffs are good because these foreign goods are actually just hurting U.S. businesses. But that is actually not the case at all in the United States today. It's actually the opposite. In America today, the cost of producing goods in America is extremely high. Our average employee and benefits in any state in America doesn't even compare to 95% of the countries in the world. Countries like China, even with tariffs, are way more competitive to sell goods to the United States than if you try to make those same goods here. And a perfect example is clothing. There are companies that tried to open manufacturing for clothing in LA. LA has a long history in the clothing industry. And there were several companies that built plants here in downtown LA and tried to compete. And what happened over time is that they went out of business. And the reason being is it was just so much cheaper to manufacture in other countries that even with tariffs and protectionist measures and whatever, it just doesn't make sense to manufacture clothes in the United States. And if you put tariffs on China, they make the clothes in Bangladesh. And if you put tariffs on Bangladesh, they make the clothes in Vietnam. And you can see this if you go to any of the retailers that you buy clothes from and you start looking at tags. It used to just mostly be all made in China, but now it's made in many companies and countries, including Turkey and everywhere else. So essentially, Trump would have to put tariffs on countries all throughout the world, if not every country, to avoid this hop and skip as companies go to other countries to manufacture cheaper than the United States. The most expensive place to manufacture is the United States and Europe. So by putting tariffs on these countries, and especially on goods like food or energy, which the countries are retaliating by putting tariffs on our goods and services as well. But just for us, as somebody buying an avocado, and most of the avocados come from Mexico. Now, the good news is if you're in California, the tariffs won't affect you because you grow the avocados here. But if you're in the rest of the country, you're eating Mexican avocados. And so you're going to just pay more for avocados because as that producer sends the goods to the United States, then they get a bill and it says you have to pay X based off the value of the goods you're shipping to the United States. And the company receiving those shipments pays the tariff. That's you and me. Because then that company looks at the avocado and says, I'm not going to make 25% less margin, so I have to raise my prices by the equivalent amount. And that's what's happening in America. So to sum it up, tariffs will not have the benefit of creating better jobs and higher wages in the United States because nobody's going to change their manufacturing, really. Now, you can get a couple announcements from foreign companies that says, oh, we're going to start manufacturing more in the United States to get around tariffs. But this is just bluster because we all know that cost is way higher than and the reality is that they're probably not going to do that. And then American consumers are just going to end up paying more for the same goods they're going to buy from the same countries that they were going to buy before. Okay. So what's happening is when the other countries are trying to retaliate against the United States, then Trump is threatening them with even more tariffs to completely try to destroy their economies. So he's trying to bully these higher costs onto U.S. consumers, but onto these countries without having a retaliation against U.S. companies that sell a tremendous amount of goods in foreign markets, including companies like Apple and Tesla, which are major players in foreign markets. And so when you start thinking about the effects of this on U.S. companies, there's a negative effect as well. So even if these countries can't put tariffs on our goods because we bully them not to, it doesn't mean that those consumers aren't turned off by the United States because of these actions and then just choose to look for other goods from other countries because they're turned off by America. And that's a risk that we take in countries in areas like in Europe. Europe is a big consumer of United States goods. And you can compare the two and say, oh, well, we buy so much more stuff than they buy of ours. That's true. And Europe has a pretty protectionist system. That is also true. But thinking that this policy will benefit the United States or U.S. stockholders is, I think, a mistaken belief system, and hence what started the correction in the stock market that we're seeing today. The second part of the correction is irrelevant of anything other than valuations. The stock market was valued extremely high at the end of the Biden administration for various reasons, most of which is that the economy was able to stay strong despite rapid increases in interest rates. And when interest rates eased just 100 basis points, that created a relief in the markets that the Fed was done raising rates, and rates ultimately control asset values a lot more than tariffs do. And so with the Fed holding rates at 4.25% today, they have a lot of room to lower interest rates and goose the value of assets if needed. Okay. The problem is that the Fed can't do that if there's higher inflation, and the policies of tariffs create higher inflation and then might hamstring the Fed from being able to lower rates. As of today, that is not the case, but we have not seen the effects of tariffs yet in pricing, and that will take a good 6 months to a year to work itself out. So currently inflation's averaging a little under 3%. And so if we look in a year and we try to predict what inflation will be, it's very hard to predict what that will be, but that will ultimately control where interest rates are. Now, my guess is that interest rates will continue to go down over time, and Trump's going to put a tremendous amount of pressure on the Fed to lower rates irrelevant of inflation. And that's going to be the next attack. And you'll see is Trump will go after Powell and say, why are rates at 4.25? They should be at 2.25. And at 2.25, everybody can refinance their loans and everybody's going to be stoked. And the stock market would go crazy if rates went to 2.25. And that's why I caution investors, don't just jump out of the stock market and think all hell is going to break loose, because the Fed can fix the problem, any of these problems, by lowering the cost of borrowing. And the cost of borrowing is a huge burden for the U.S. government as well. So when you actually think about the potential scenarios this year, tariffs slow down the economy slows, and even if we get down to the potential of a recession, the Fed will come into action and begin to lower rates. Okay, and that will goose asset prices and support these policies by lowering the costs that we all pay on our loans. And by lowering that cost, it puts more money in consumers' pockets, even though the cost of inflation has gone up and the cost of goods have gone up, the cost of money will go down. And so I think that is basically the philosophy, one of the main philosophies that Trump is working on, is that the cost of tariffs will be offset by a lower cost of money. Secondly, it's all about the redistribution of wealth. Tariffs are a way for the U.S. government to collect money on consumption versus on income. And you can see this desire in the Trump administration to move away from income-based taxes and to try to continue the tax cuts to the wealthy. In fact, they're proposing tax cuts for millionaires, and people who make over $1 million in income will get tax cuts under their current tax plan, especially in states like California, when they increase SALT. And that's what they're talking about doing, increasing the deduction people can take on their state taxes and other taxes that you normally can deduct. And so basically what they're proposing is taxes won't go up for the wealthy and actually will be cut for many wealthy people. And then taxes won't go up for anybody somehow. And then basically the tariffs are going to offset this somehow. But what that really means is that the taxes are going up on everybody who consumes goods. So it's a shift of the taxes from the wealthy to the lower and the middle class. And so when you look at tax policy and tariff policy together, along with monetary policy, you can see the shape of the way they're trying to adjust the economy to benefit the wealthy, to change the tax burden from wealthy to middle and lower income people, and to try to create jobs through this by protectionism, offset by lower cost of money from the Fed, which will then offset higher cost of living. So that's the calculus that the stock market really isn't into, because all these things have to go exactly right for it to work. And we all know that that never really happens, right? So there's a lot to this. On top of the idea of having peace in Ukraine, which has a wildly bullish effect actually on markets and everything, irrelevant of the political side of Ukraine, the economic side, it would be beneficial. Obviously, war is very bad for all economies and very costly for everybody. So certainly ending the war in Ukraine has a very positive impact, especially in Europe, I think, but also just for the global economy. So there's really positive things that can happen to offset the really negative things that we're looking at. And so that's why I'm telling all of our investors, the game isn't to get out of the game at this point, because I think it's a little bit premature to cry recession and this is all going to go to crap. We tend to like to do this because a lot of people dislike Trump. So it's easy to, oh, the whole world's going to end. And especially if you're more liberal, but if you are extremely conservative or a MAGA person, you're thinking this is all great. So, I don't think MAGA people are cutting their spending because Trump's president, even though other people might be extremely concerned and cutting back. So we don't know what consumer spending. We know consumer sentiment's down. Basically, the next several months will be extremely telling with the economic and societal numbers that we get of what's actually happening. Are people still spending? I know they're spending less than they were in January and December. So here's what we're doing. First thing is we're diversifying more. We're starting for the first time in years to invest in Europe and a little bit in Asia. And we think there's a lot of opportunity in diversification. We think this is an opportunity for Europe to actually shine. There's a lot of factors that Europe has been uncompetitive and not motivated to really make their economies and their governments more efficient and working together. But when you have an existential threat like Russia and a lack of support from your biggest ally, it forces, historically extremely strong countries to actually refocus. And this is great news. Germany got a great new chancellor. England has good leadership. France, maybe not so much, but when push comes to shove, we expect Europe to work much closer together, spend a lot more money, get their economies going, and stop sort of relying on this idea that the United States is their protector. This is great for Europe, actually. It's wonderful. And we're going to put more money into Europe because of that. We put a little money into Asia, Japan and China, for example. Other areas of the world, valuations are cheaper. We're looking at investing more in harder assets like gold and less so in riskier assets like Bitcoin. It turns out that the entire Bitcoin thing that Trump was talking about is basically just smoke and mirrors. So the rally in Bitcoin was an opportunity for us to take profits in our Bitcoin position, which we did. And we reinvested those profits into gold, which is a tremendously great asset in uncertain times. So we're adding gold to portfolios and we're adding foreign stocks to portfolios, as well as the fact that with interest rates so high still and the risk of a recession being discussed, it makes government securities and safe income securities very attractive. We've seen a nice rally in REIT securities in this year as well. So if you take out U.S. stocks and you look at the other assets, REITs, bonds, and foreign stocks, you're having an up year. It's the U.S. markets that are down. Everything else is doing just fine. And I think that that's something to pay attention to as an investor. And it's the moves that we're making as a firm is to further diversify your portfolios and actually have less U.S. risk and more foreign exposure moving forward into the next year. And that's what we're doing. And we've added more individual foreign stocks into our positions as well, which we'll go over during our stock discussion, which will follow by question and answer with our wonderful co-host, sort of, our guest, Mia Sampson. So when push comes to shove, is this the economy that I would design? No. But when you also look at what our other choice was, which was the Biden-Harris economy, also had many risks involved with it as well, and many problems. Despite having stability, we also had a series of bad policies under Biden as well. Most of them were pro-labor policies that drastically increased the cost of employment for most companies. And so to just assume that markets would be better off with Biden and Harris is not necessarily true, or under a Kamala Harris government. We don't know what we would have gotten. That's probably why she lost, was she couldn't clearly define what we would be getting moving forward, when she could have said, how about stability and have actual policy? But that said, that's not what happened. We have Trump. We're going to have Trump for many more years. Being business people, their penchant is to make money. So that would seem to be in our advantage as stock investors, but being ignorant doesn't help. And if you just watch Howard Lutnick in an interview for any period of time over 3 minutes, you'll realize the problem with our country. So if you want stability and you want safety, it's not going to be in the U.S. stock market. That's for sure. Now, where are we going to be in 4 years, higher or lower? I can't tell you. I just don't know. Over time, the stock market's always gone up. But in short periods of time, it can be very difficult. So that's our reality. I wish I had better news for you, but I don't. The market's still expensive. There are great companies with great earnings prospects in the U.S. stock market, so we're not bailing on that. But maybe a little less exposure is what makes the most sense, and certainly exposure to high PE, high risk investments. And that's why we're also seeing like dividend stocks outperforming growth stocks and value stocks outperforming growth for the first time in years. And I don't think that's a short-term trend. I think that's a more longer-term trend that we're going to see. So we're going to see a rotation now from, risk to real returns, real dividends, solid companies, different types of companies. And that's the shifts we're trying to make for our clients so that we can continue to be ahead of the curve and try to take advantage of what I still think is a positive environment for equities globally over the next year. And also with lower rates coming, it's also very positive for equities and real estate as well. So I think the biggest factor that people should pay attention to is rates and less so on tariffs. So the purpose of today and the purpose of this monologue was really to try to get you to calm down. Okay. Just everything's going to be okay. We're not in a horrible situation, at least as of now. The economy is still very strong. Earnings are supposed to be really good. Stock prices were high and a correction was due. And Trump gave the market a great excuse for a correction. But if you're looking for stability, that's not what America voted for. America voted for Donald Trump and they voted for the changes that he's making. And that's how democracies work, whether we like it or not. And there are many things I don't like, but that is America. So that said, how do we make money? And that's what we're focused on, is where can we make money, not political issues that we're not going to solve.